Welcome to the Deep Dive. Today we're looking at a true investing legend, Peter Lynch. He ran the Fidelity Magellan Fund from 77 to 90, and, well, the numbers are just staggering. An average annual return of 29%.
Yeah, 29%. It's almost hard to wrap your head around nearly tripling the market consistently for over a decade.
Incredible.
But what's really key, I think, is that Lynch didn't just keep this playbook for the pros. He wrote one up on Wall Street, basically telling individual investors, hey, you can do this too.
Right, and that's our mission today, isn't it? To really unpack how you, the listener, can use your own everyday knowledge, maybe some patience, some discipline, to potentially find great investments, maybe even outperform the professionals.
That's the core idea. Lynch fundamentally believed that ordinary people, just by, paying attention to their surroundings, what they buy, what stores are busy, what products are taking off, they can spot these huge opportunities way before Wall Street analysts even notice them.
It's like saying you have this built-in Main Street advantage over Wall Street.
It's
So let's dig into that. This idea of the individual investor's edge. It kind of goes against what you usually hear, right? That the big institutions have all the advantages.
It does seem counterintuitive at first glance, but Lynch's point was powerful. You, as an individual, you're out there. You see a new restaurant chain maybe, and it's always packed, or your kids are suddenly obsessed with a certain brand of sneakers.
Yeah, you see it firsthand.
Right. Or maybe a new software tool is just everywhere in your office. These are tangible signs of growth, things you observe directly, potentially months or even years before an analyst buried in spreadsheets gets a whiff of it.
So it's less about complex financial models, initially at least, and more about just, well, opening your eyes.
Precisely. And think about the constraints the big funds face. They often have to invest huge sums. They have strict rules about what they can buy, diversification requirements, benchmark hugging.
Things you don't have to worry about.
Exactly. You have freedom. If you find a great small company, you can invest a meaningful amount for you. You can hold it for years if the story stays good. The pros often can't do that. They're playing a different game. So you really can spot things they might miss or things they simply can't act on effectively.
Okay, that really reframes things. It's empowering.
Mm.
So let's say you've noticed something. You've seen a trend. What's next? Lynch wasn't just saying, buy what you like, right? He had a system.
Oh, absolutely not. Observation is just the starting point. He developed this really useful framework, classifying stocks into 6 basic categories. It's crucial because it helps you understand what kind of company you're actually looking at.
What you're buying into.
Right? And what kind of growth and risk you should reasonably expect. It manages your expectations.
Okay, so let's walk through them. First up, slow growers. Sounds pretty straightforward.
Yeah, slow growers are usually your large, mature companies. Think big utilities, maybe some established industrial giants. Their growth is modest, maybe a few percent a year.
Not very exciting.
Maybe not for huge capital gains, but Lynch pointed out they often pay reliable dividends. They can be a stable part of a portfolio, sort of an anchor, especially when the market gets choppy. They're safe, but probably not spectacular.
Got it. Then there are stalwarts. These sound like the big, reliable names people know.
That's a good way to think about them. Companies like, say, Coca-Cola or Procter & Gamble historically fit this mold. Medium to large, established businesses with pretty consistent earnings growth, maybe 10–12% a year.
So dependable.
Very dependable. They're not usually going to give you explosive growth, but they're solid performers, tend to do okay even in recessions. Lower risk than some other categories. Good core holdings.
Okay, now for the exciting one. Fast growers. This is where people dream of finding the next big thing, right?
Absolutely. These are often smaller, maybe younger, aggressive companies growing really rapidly. Think 20–25% growth per year or even more. Could be a hot retailer expanding nationwide or a tech company with a disruptive product.
Huge potential upside.
Huge potential. These are the ones that can become 10-baggers, as Lynch called them. But, and this is a big but, they come with much higher risk. They can flame out, competition can crush them. You need to really understand their growth story.
Right. Makes sense. What about cyclicals?
Cyclicals are companies whose fortunes rise and fall with the overall economy. Think airlines, car manufacturers, steel companies, sometimes housing. When the economy's booming, they make a lot of money.
But when things slow down,
They can get hammered. Profits can disappear, stock prices can plummet. Lynch stressed that timing is absolutely critical with cyclicals. You have to be good at spotting the turns in the economic cycle, which is frankly very difficult. Get the timing wrong and you can lose a lot.
it sounds tricky. Then you have turnarounds. Investing in companies that are in trouble, Seems risky.
It is risky, high risk, potentially high reward. These are companies that have stumbled badly, maybe near bankruptcy, maybe hit by a scandal or a major product failure. But crucially, there's a belief they can recover.
So you need to see a path back.
Exactly. Is there new management? Are they selling off bad divisions? Is there a clear plan? If the turnaround works, the stock can soar. But many turnarounds, well, they don't turn around, they just keep sinking. Requires deep research into the specific problems and solutions.
Okay, last one. Asset plays. What are these?
Asset plays are companies where the value of their assets, maybe real estate, cash, patents, even brand names sometimes, isn't fully reflected in the stock price. It's like hidden value on the balance sheet.
Like finding buried treasure.
Sort of. Maybe a retailer owns valuable land, or a company has a pile of cash worth half its stock price, or valuable patents nobody's noticing. Lynch was saying sometimes the sum of the parts is worth way more than the current whole. You need to dig around in the company's financials to find these.
Wow, okay, so understanding these 6 categories really gives you a lens to view potential investments. It tells you what game you're playing with each stock.
Precisely. It frames your research and your expectations.
So you've spotted something, you've maybe tentatively categorized it. Now comes the homework part. Lynch was so insistent on, you can't just stop at the category, right?
Not at all. That's where fundamental analysis comes in. Lynch was absolutely adamant. You must research the company thoroughly before you invest a dime. This is about moving from a hunch or an observation to an informed decision.
And what specific things should, an average person look for? Someone maybe without a finance degree.
He kept it pretty practical. First, look at earnings growth. Is the company consistently making more money? Look back several years. Erratic earnings are a warning sign.
Okay, consistent profits. Makes sense.
Then, the price-to-earnings ratio, the PE ratio. This tells you how much the market is valuing the company relative to its profits. But don't just look at the number in isolation.
Compare it.
Yes. Compare it to the company's own historical PE range and compare it to competitors in the same industry. Is it unusually high or low right now? That tells you a lot about market expectations versus maybe an opportunity or a red flag.
Got it. Context matters.
Yeah.
What else?
Debt. Check the balance sheet. How much debt does the company have compared to its equity? Too much debt makes a company fragile, especially if business slows down. Lynch preferred companies with strong balance sheets, manageable debt.
Safer bets.
Generally, yes. And look at cash flow. Is the company actually generating cash from its operations? Profits are one thing, but cash is king. A healthy cash flow means it can fund its growth, pay dividends, survive tough times.
And beyond the numbers.
Yeah.
You have to actually get what they do, right?
Absolutely fundamental. You need to understand the business model. How does this company actually make money? Can you explain it simply? And crucially, does it have some kind of competitive advantage, what Buffett calls a moat?
Something that protects it from competitors.
Exactly. Could be a strong brand, network effects, patents, low-cost production, unique technology, something that makes it hard for others to muscle in on their turf. If you can't understand the business or identify its edge, Lynch would say, stay away. These are real, concrete things you can research.
Which leads us perfectly into what might be his most famous piece of advice. Invest in what you know. It feels like the core of that individual investor edge we talked about.
It really is. It ties everything together. Your job, your hobbies, your shopping habits. These give you firsthand knowledge of certain industries, companies, products. Leverage that.
So if you're a doctor, maybe you have insights into medical device companies or pharmaceuticals.
Precisely. Or if you work in software, you see which tools are actually gaining traction. If you're a teacher, you see trends in educational materials or tech. If you notice a local restaurant chain expanding like crazy and the food's great, investigate.
He had some great stories about that, didn't he? Like leg stockings.
Yeah, the legs example is classic. His wife noticed them selling incredibly well in supermarkets, told him about it. He researched Hanes, the company behind them, and it became a huge winner. Same idea with Dunkin' Donuts or Taco Bell. People saw them spreading, saw the lines, before Wall Street caught on.
So your everyday life is basically a research lab.
That's the idea. You already have expertise in certain areas just by living your life. Use that advantage. Don't invest in some complex biotech company if you don't understand biology just because you heard a tip. Stick to areas where you have some inherent understanding.
That's really liberating advice. Okay, so you've done the homework, you understand the business, you've invested, but then the market goes crazy, which it often does. How do you handle the noise?
Lynch was huge on patience, the long game. He believed that successful investing wasn't about timing the market's short-term zigs and zags, but about finding good companies and holding on to them.
Letting compounding work its magic.
Exactly. Compounding is incredibly powerful, but it needs time. Many of Lynch's biggest winners took years, sometimes a decade or more, to multiply many times over. He had to resist the urge to sell just because the stock went up or because the market had a bad month.
So tune out the noise, the daily headlines, the forecasts.
He was very skeptical of macroeconomic forecasts. He'd say nobody can consistently predict recessions, interest rates, or what the market will do next quarter. It's a distraction.
Focus on the company instead.
Right. Focus on the fundamentals of the businesses you own. Are earnings still growing? Is the balance sheet strong? Is the story still intact? If the answer is yes, then ignore the short-term market gyrations. Have the discipline to hold on. That's how you can benefit from long-term growth.
Speaking of long-term growth, Lynch coined that famous term, the 10-bagger. Every investor's dream, right?
Yeah, the 10-bagger. That's a stock that goes up 10 times from your purchase price. A $5 stock becomes a $50 stock. It's the home run.
And his strategy involved actively looking for these potential monsters.
Yes, his goal was to find companies, often in that fast grower category, that had the potential for this kind of explosive tenfold growth. And then, crucially, holding them long enough to let it happen.
And the idea is that just one or two of these can make a huge difference to your overall returns.
Absolutely. Lynch found that in his portfolio, a few big winners, these 10-baggers, often accounted for a massive portion of the overall gains. They could essentially make up for several investments that didn't work out or only delivered mediocre results. They pull the average way up.
Okay, so beyond finding 10-baggers and being patient, what other sort of practical day-to-day advice did Lynch give?
He had quite a few gems. One was keep it simple. If you can't explain what the company does and why you own it in like 2 minutes using simple language, you probably shouldn't own it. Avoid things that are too complex or opaque.
Good rule. What else?
Diversify, but don't overdo it. Owning just 1 or 2 stocks is too risky. But owning, say, 100 stocks means you can't possibly keep track of them all, and your winners get diluted. He thought maybe 10 to 30 stocks was a reasonable range for an individual.
Enough to spread risk, but few enough to actually follow them.
Exactly. Also, be very skeptical of hot tips, especially ones you hear at parties or from people who don't really know what they're talking about. Always, always do your own research.
Don't just follow the herd.
Never. Another tip. Check insider buying. When top executives are buying their own company's stock with their own money, that's usually a pretty strong positive signal. They know more than anyone.
Good point. And the flip side, maybe the hardest part, knowing when to actually sell a stock.
Yeah, that's tough. His advice was basically, sell when the fundamental story changes for the worse. Maybe the reason you bought it is no longer true. Growth slows dramatically and permanently, not just a temporary blip. Debt balloons. Competition eats their lunch. Or sometimes the stock just gets wildly overpriced compared to its realistic prospects.
So it's not about market timing, but about the company's specific situation deteriorating.
Precisely. It comes back to knowing the story and monitoring whether that story still holds true.
Okay, this has been fantastic. I mean, Lynch's core message really boils down to this. You don't need to be a Wall Street genius to be a successful investor.
Not at all. It's about using your own common sense, your observations, doing that essential homework, and then having the patience and discipline to stick with good companies.
So the key takeaway for you, the listener, is that by paying attention to your world, researching what you understand, and playing the long game, you really can find winning investments and build wealth over time. It puts the power back in your hands.
It really does. It's about being informed, being disciplined, and trusting your own research.
So here's a final thought to leave you with. If Peter Lynch urged people to find opportunities in their daily lives, what small thing are you seeing right now? A busy store, a popular app, a trend at work that might just be the seed of a future 10-bagger? Something to think about.